I do want to apologize to everyone for the rain. I travel to Dallas several times a year, and every time I come to Dallas, they say it only rains when I'm here. Every time I'm in Dallas, it rains. So if it doesn't rain too much, it's probably because I'm here that you guys are experiencing the flooding tonight, so I'm sorry. Don't hold it against me. Oh, I'm flying out tomorrow morning, so you guys are good. Y'all are good. I'm actually from Cleveland, Ohio. Don't hate me if, oh wait, actually you guys just beat us yesterday really bad, so y'all should just feel sorry for me for being a Browns fan. No, but as it says, my name is Mike Cozart. I'm a Senior National Education Specialist with Equity Trust, and tonight I'm talking about self-directed IRAs, but I've been doing this a while, and I'll tell you guys that there's something in this for everybody. So if you're already using a self-directed IRA today, there's something in here for you. If you're not, there's definitely something in here for you because this is powerful stuff. If you guys could do me a favor, I'm going to ask for some quick participation so I know where the room is at. First off, who here has a retirement account? Any type of retirement account? Now keep your hands up if inside that retirement account you actually own real estate. Okay, very good. Do I have any note investors in the room? Any note investors? Private lenders? Okay. Now these are all things that you can do in your IRA, and I was trying to get an idea if anyone is actually doing these. One more. Who here has a health savings account or has heard of a health savings account? All right. Not many people know that you can actually take your health savings account, if you qualify for one, invest it into real estate, which is something you all probably know a little bit about, grow your health savings account tax-free, and pay for your health care tax-free. Pretty powerful stuff, right? That's what we're talking about. In fact, there's actually 7 different self-directed accounts that are tax-favored in the eyes of the IRS. And I'll tell you guys, if you're not using at least 2 or 3 of these, you're missing out. You're leaving some stuff on the table. I'm going to make sure you guys know these 7 accounts tonight. I'm going to share some stories of Equity Trust clients, people that are actually doing this today. I'm actually going to share with you guys 5 different deals that folks have done with their IRAs and other accounts. And I'll tell you that in 4 of those deals, the investor used less than $20,000. Okay? So I know a lot of times when I'm talking about this, a lot of folks feel they're left out because they don't have a lot saved for retirement. They don't have a lot of funds available, but I'm going to share with you that I've seen many people get started for less than $1,000 and turn around a pretty nice retirement portfolio over time. But I'm going to share with you how they got started. So if by the time we're done tonight, if I could show you guys how to pay for retirement, health care, and a kid's education tax-free, would that be okay? Good time spent? All right. Before I do that, I have to do something really, really exciting with you guys. As you guys can see the excitement on my face. This is exciting stuff. In the back, if you guys want to stand up and read this. No, you can't do that, okay. No, guys, this is a disclaimer, obviously. I represent Equity Trust. We are a self-directed IRA custodian. But I have to tell you, we're here purely in an educational capacity. Basically what this means is we don't render tax, legal, or financial advice. So I'm not an attorney. Although I talk with a lot of attorneys and I work with a lot of attorneys, I'm not an attorney. So there may come a point where someone asks me a question and I have to say, sorry, you should probably talk to your attorney for that. I'm also not an accountant. I'm not a CPA. I do understand a lot about taxes. I understand a lot about how these work. But you still need to utilize those folks where necessary. But this is also where I want to stress, as we're talking about the topic of self-directed IRAs, I want to stress the word self. It's a beautiful thing when we're talking about self-directed IRAs because it puts the power in your hands. You get to choose your own investments. You choose what you want to invest in. But you still have to do your due diligence because if you don't, a deal could go wrong. You could potentially lose money. It could be a bad deal. And the onus is still on you, right? So when we talk about self-directed IRAs, just because we talk about real estate, it doesn't mean we're necessarily endorsing every real estate deal. Does that make sense? And you guys are probably wondering why I have to say this, but there are people who have assumed that because we're talking about that, that's what we mean. So have to make this disclaimer up front. But now that I've gotten past the exciting stuff, I want to ask you guys as I go through this, some of this is going to be talking about taxes, which I know is the most exciting topic to talk about at 8:30 on a Monday night. If you guys could have fun with me, participate, let's take some notes, let's have some fun, and we'll all get through this a lot better and a lot more enriched. Is that fair? Okay. So, real quick, I'm going to give you guys my contact information. We'll tell you a little bit about myself so you guys have an idea where I'm coming from so that I can tie this in. Now, you'll notice I don't put my phone number up here because as our national education specialist, that requires me to live on an airplane and not be at home at my home office. So if you guys get a business card from me, it has a phone number to a desk that I'm never at. So I will make this offer to everyone here. After tonight, if you guys are interested in speaking with me, if you're interested in learning more about self-directed IRAs, you all can email me anytime. My email is actually on my person, on my phone, at all times. But anyone who's interested in learning more, he had actually passed out those cards. If you return those to me by the end of the night tonight, I will actually give each and every one of you a contact at Equity Trust who can answer the phone and spend as much time as you need discussing this for yourself, okay? I've been with Equity Trust for about 3 years. My background is in economics and finance. I have been an investor since I was 17 years old. For me, self-directed IRAs, it's all about investing in what you know. Okay, so for a lot of folks in this room, that has something to do with real estate, right? That's why we're here. For me, when I first started and I learned I could do this stuff, again, I had studied economics and finance in school, and like most Americans, I understood IRAs and 401ks and all these accounts to be synonymous with investing in the stock market. So for me, when I'm saving and putting money into an IRA, it's so I can go invest in the market. It's so I can invest in mutual funds. I had no idea, because they don't teach you this stuff in school, that you can invest in real estate. Your IRA can be a private lender. Your IRA can invest into a private company. How I got started in the self-directed IRA, I actually knew someone that was in real estate. He had been rehabbing houses. I found out I could do this, and I wasn't liking the return I was getting in one of my portfolios, so I said, hey, do you ever need more money to do a rehab? And of course the answer was yes. So I started out doing private loans in my retirement account. Today, I'll tell you another passion of mine outside of this is craft beer, right? And it's not necessarily that I enjoy drinking it, of course I do. It's not about that, but I actually have a business where I teach people how to homebrew and brew your own beer at home. And an opportunity came up for me to invest in a startup company that was a brewery and beverage company. And after my research, I did that using my IRA. Actually, that one was in my 401k. The reason I tell you that is this. My friends that I brew beer with, it was actually a pretty cool conversation. And there's a really good lesson in this. We're sitting in my living room, and the opportunity had come up to invest in this brewery, and we're all excited to do so, but we're talking about investing $10,000 minimum. So I know what I can do. I'm in, I'm good to go. My buddy's sitting on my couch to the right. He said, absolutely not, no way. Are you crazy? $10,000? I will never have $10,000 to invest. What if the company goes bad? What if I lose money? I don't even have that. I'm never even gonna have that amount of money. And he's literally flipping out because $10,000 is so much money to him. So he's out. He says he can't do it. But there's a guy sitting across from me who actually just used to work at Equity Trust with me, and he said, Mike, can I use my Roth IRA to invest? And I said yes, because I'd already done that research. And you should have seen the light bulb go off in the first guy's head when he learned that he could actually invest in something other than the stock market, other than mutual funds, other than what his financial advisor has told him that he can invest into. And he actually did end up doing the investment himself. The reason I bring this up in a room for real estate is, if you're out there looking for private lenders, if you're looking for folks, if you're always looking for more capital to do more deals, most Americans have a majority of their investable wealth inside their retirement accounts. So you may be sitting next to someone that you don't think has very much money. They could never be an investor. They could never back one of your projects. But they just might have it in their retirement account. And it would surprise you, because a lot of people have been very diligent in saving. Okay, so it's an extra tool to have in your belt. If you understand self-directed IRAs, you could potentially find an investor for some of your projects if you understand how to do this stuff, okay? So what is a self-directed IRA? I'll make this one brief. I know some of you guys have a self-directed IRA here. Self-directed IRA is no different than the IRAs that you have today, no different than the retirement accounts or the HSAs you have today. In fact, if you guys read the tax code, and I'm sure everyone here has read the tax code, it's exciting stuff. You will not see the word self-directed in the tax code when it talks about IRAs. It's a marketing term. So an IRA at Fidelity or Schwab or TD Ameritrade is the same as an IRA at Equity Trust. The only difference is if I go to Fidelity, where I have a Roth IRA that I trade stocks in today, and I say, hey, I want to put an offer on this property, and I'm going to need to put some earnest money down, and I want to do this with my Roth IRA. What's Fidelity going to do? They're going to tell me no. They're going to look at me cross-eyed. I might even get someone fun that tells me it's illegal. It's just absolutely not, okay? A self-directed IRA is just an IRA with a custodian that allows you to invest outside of just the stock market, okay? So Equity Trust is purpose-built for that. In fact, we are the oldest and largest self-directed IRA custodian. There's a man named Dick Desich who is credited with starting the self-directed IRA industry. He started Equity Trust. Short version of the story is, you guys have actually been able to do this, invest in real estate with your IRA since the 70s. In fact, in 1974, the IRA was created. Prior to 1974, do you guys know what were the two sources of retirement income for most Americans? Pensions and Social Security, right? So IRAs were created under this thinking. You have this IRA, which by the way now today is called a traditional IRA, for those of you that have one of those. And the thinking was this: let's incentivize people to save for retirement so that they're not so dependent on things like Social Security and pensions. Let's incentivize them by giving them a tax deduction in their income earning years for the money they put into these accounts. Okay, so if I put $5,000 into a traditional IRA, $5,000 is taken off of my taxable income. That's an incentive, right? And this account is tax favored. So all of these accounts we're talking about are tax favored. And what that means, and this is good if you're taking notes, is there's several different types of income that these accounts do not pay a dime of tax on. I'll list the three most relevant for people in this room. First, if your IRA generates a capital gain, what would normally be a capital gain to you and I or our businesses, an IRA does not pay capital gains tax. So if you go out and flip a property and your IRA is involved in it, no capital gains to the IRA. Next, rental income from real estate. So if your IRA or your HSA is involved in a rental property, that rental income that goes to the IRA is exempt from tax. And the third, and one of my favorites, is interest income. So as I like to have my IRA be a private lender, if my IRA lends money out and generates income in the form of interest, it is exempt. There's many other types of income that are exempt, but those are the three that you guys will probably see if you're doing real estate. Okay? Yeah?
So do you think, I guess you won't take depreciation, or are you forced to on a rental property?
So the question was, I'll simplify. Where does depreciation come in? Well, depreciation is something that you claim to reduce your taxes, right? But if you're not gonna, if your IRA doesn't pay taxes, do you need depreciation? No, no. Depreciation doesn't matter in this case because there's no taxes to write off from the income. So very good question. I get that one a lot. So these accounts are gonna grow without taxes. I'll get you in 1 second. They're gonna grow without taxes being taken out. And in a traditional IRA, when you take money out in retirement to use to live on, you'll pay taxes at that time. And the thinking was, hey, you know, back in the 70s when these were created, during your income earning years, we give you a deduction, and then later on in life, we're gonna have you pay taxes then, because we're assuming you're at a lower tax rate. Here's the problem. If you're an investor, especially in real estate, and you take time to build up your real estate business, there's a lot of people that I know that their highest tax rates potentially are actually later in life because they've built up larger portfolios. So that's where something like a Roth IRA comes in, which we're going to talk about in a little bit. Do you guys know what a Roth IRA is? Okay. Yes?
I didn't catch what you said the second thing was that was not taxable.
The second one was rental income. There's others too, like dividends and royalties and stuff, but those don't really come into play too much here, okay? So that's the thinking behind these accounts. So 70s, you were able to start doing this. No one's really investing it in real estate because no one knows you can do it. No one's really thought of that yet. Early 80s, Dick Desich puts two and two together, gets an IRS determination letter, and the self-directed IRA industry starts. He actually took 22 investors, IRA funds, put them together to buy a piece of commercial property in Oberlin, Ohio, triple net lease. Some of these investors who started with 6,000, I think it was 6 or 5,000 in IRA funds, got over $200,000 in the deal back to their accounts, not taxed. Okay, so that sounds like a pretty good idea, right? Word spreads, and Dick gets asked to go all over the country and do what I'm doing today and teach folks in rooms like this how to do real estate in your retirement account. Okay, so that's how the industry started. Dick Desich actually started Equity Trust today. We are actually the largest custodian. We are an IRS approved custodian. Don't assume that because someone promotes self-directed IRAs that they're a custodian. Basically what that means to you is we're a regulated financial institution, and there's a lot of protections in place for our clients. You know, audits, checks and balances in the system to make sure your money is where it is and everything is secured, right? Your cash is actually FDIC insured, stuff like that, okay? But we have over 130,000 clients today. We're in custody of over 12 billion in assets. I don't say that to say we're big and bad, but I want you guys to know if you do choose to do business with Equity Trust, you know, we're not a fly-by-night company, okay? What makes us different, I'll give you two things, and then we're going to get into the meat of the presentation. First, when you work with us, you actually will be working with an investment liaison. This is crucial. This is different than most of our competition out there because we're such a large company. We have people that do nothing but help people invest in their retirement accounts. They help you execute your deals. I'm gonna actually walk through some deals with you guys and share where these people come in. But the average person at Equity Trust that you'll be working with has been there at least 5 years and has done over 2,800 real estate transactions in their career with us, just using IRAs, okay? So I want you guys to know you're working with someone who's done this before and they can hold your hand as there's a couple slight differences from what you may be doing today, okay? Also, what makes us different, our education. Okay, so this is a new topic to some of you guys tonight. If this is something that is for you, I'll give you an opportunity to get started. I'm not here selling a $5,000 education product. I pretty much will say at the end of the night, if you guys want to open an account, if you don't have one already, you can do so. That's pretty much where we're going. Once you get started, the education doesn't stop. You want to continue to educate yourself. We have a huge education library. We actually put on workshops so you guys can actually have someone like myself in person working with you. So there's a lot of different things we do to make sure you guys know how to do this and you know how to do it right, okay? So why use a self-directed IRA? I'm going to give you guys a few different benefits. First, tax deductions. Okay? You guys may be looking for tax deductions out there. There are accounts that I'm going to tell you about tonight that you can potentially contribute up to $53,000 or $59,000 from your business to your retirement and potentially get a tax deduction for that. And then you could grow that without having to pay tax all along, right? Because it's in one of these accounts, okay? Even if you're talking on a smaller scale like a traditional or Roth IRA, there's some smaller contribution limits in there, but I'm going to basically share with you guys the tax deduction part of it is pretty huge for a lot of business owners, okay? Also asset protection. So your IRA is a separate legal entity from you. It is protected from your creditors. Every state is different. Generally speaking, you're protected up to $1 million. Your IRAs are from your creditors. Actually in Texas, I believe it's 10 million because everything's bigger in Texas. Don't quote me on that, but I'm pretty sure that was the case. So asset protection, right? So if you have to file for bankruptcy, if you're in real estate, right, potentially will create some challenges. But if you've also been building a portfolio in real estate inside your retirement account, that could be protected should that happen to you, okay? Estate planning, you have the ability to potentially pass these accounts to your heirs, and some of these accounts will pass tax-free and not go through the whole probate process. So you could potentially be leaving tax-free dollars to your heirs, which is incredibly powerful. Yes, sir?
If your heirs then take it out, do they pay taxes on it?
Depends on the account. Depends on the account. So his question was, do your heirs pay taxes when they take it out? And that depends on which one of these you use. So when I go over the 7 accounts with you guys, there are some that are what's called tax deferred, which that's just like the traditional IRA I was talking about, where you would get a deduction for the money you put in and you pay taxes in retirement. Those ones, your heirs would have taxable income when they draw from the account. If you go with something like a Roth IRA, where you forego the tax deduction when you put the money in, and it grows tax-free and you never have to pay taxes on it again, that can pass to your heirs tax-free. And when they take money out, it's tax-free as well. What's that?
If you have a Roth IRA, you put a certain amount in, you never have to pay taxes on that. What about?
You don't pay tax. So in a Roth IRA, you don't pay taxes on the growth because it's a tax-favored account. And when you go to take money out in retirement, whatever you take out is tax-free.
You started with 50,000 and wound up with $1 million, you wouldn't have to pay taxes on the area.
Correct, yeah. So if I've contributed $50,000 to a Roth IRA over time, and I've grown it to $1 million by the time I retire, that's $1 million of tax-free income I can pull from. Yeah, it's incredibly powerful. Actually, a gentleman up here mentioned Mitt Romney. Political affiliations aside, Roth IRAs started to get a lot of attention when he was running for president because Mitt Romney has amassed some ridiculous amount, like $20+ million in Roth IRAs. So conceivably, this guy can not only live tax-free for the rest of his life, but have his kids pretty much live tax-free for the rest of theirs as well when he passes on. So these are potentially really powerful tools if you get started on them and you diligently work at growing them, okay? Here's the big one, and we've kind of talked about this. It's the taxes. The taxes is a huge benefit. You guys ever heard of Albert Einstein before? Pretty smart guy. He's rumored to have said that the most powerful force in the universe is that of compound interest, okay? I think I'm pretty smart too, so I'm going to amend his quote and say, I think the most powerful force is compound interest with the absence of taxation. Because if you're growing your money in these accounts and you're not having taxes taken out, it's incredible how fast you could grow this compared to doing investing in the taxable world, okay? I'm going to show you guys a mathematical example. This is not up here to say, hey, if you move your money to equity trust, you're going to get these types of returns. This is just going to illustrate a mathematical principle. So if you guys were to take $20,000, invest it over a period of 20 years, and get yourself a 12% rate of return, in the taxable world at a 25% tax rate, you would have $112,000 at the end of 20 years. But if you did those same exact investments inside a tax-sheltered vehicle like an IRA, at the end of 20 years, you would have $192,000 solely because your investment income is not taxed, okay?
What is the non-IRA here? What is that?
Non-IRA just means you're investing outside of an IRA. You're investing in the taxable world.
Self-directed?
Nope. You're investing in your name, you're investing in your business's name. That's what the left-hand side is. The right-hand side is if you're investing in an IRA, okay? Can be a rental property, could be a private loan, whatever the case may be. And again, this is a mathematical principle. It's obviously, 12%. Some people know how to get a greater than 12% rate of return. Some people don't know how to get that much. It's just to illustrate a principle, okay? Now, obviously, we'd all rather have $192,000. But I'm not suggesting that you go out and do all of your deals inside your retirement account. Because we need to invest now to put food on the table in some cases. We need to go on vacation and pay bills and all this fun stuff. We want to live life now. But now that you know you can do this, doesn't it make sense that you take advantage of it and at least do some deals in a tax-sheltered environment to help grow your pipeline for the future? How many of you guys have ever heard of Life and Air before? Life and Air? It's like Millionaire, but with life. Life and Air. Yeah. I borrowed this from them with their permission, but something they teach is on the 4 stages of financial prosperity. I'll go through those with you guys now, actually, very briefly, and kind of tie this in, because we're all in a different state. We're all in a different phase right now. But there's something in this for everybody. The first stage of financial prosperity is to create your vision. You have to have a vision in place in order to know where you want to go, right? You have to have your vision of what prosperous is to you. A lot of people tell me they have a vision, but when I ask them what their goals are, what their vision is, they tell me how much money they want to make. They tell me how much money they see in their bank account. That's not a vision. Money is not a good motivator. It's what you want to do with that money. Does that make sense? So creating a vision is all about what do you want to do with that money? What state do you want to be in? I'm not going to talk about creating a vision tonight. You guys can do that on your own. The second stage is meeting your current needs. Okay? So this is where you're trading hours for dollars. Okay, you're going out and working to create income to cover your needs right now. Okay? And this is a very important stage. The third is creating excess. Okay? So you're working on meeting your financial needs, but you also need to start creating some excess once you get to that point. And these are things that, you could go on vacation with this money. You can pay down debt. You can do a lot of different things when you have excess above your financial needs. And the fourth phase really ties into self-directed IRAs, and that is building a pipeline of income-generating assets. Now, some people don't believe in doing income-generating activities in the sense of, some people don't like rental properties, they rather do flips, okay? But in this phase, the goal, and this is how it ties into retirement, the goal is to have your income from this pipeline that you've built replace the income from stage 2, so you're no longer trading hours for dollars, and your money is working for you. How many of you know there's a difference between you working for your money and your money working for you? Okay? IRAs really fit into number 4. Okay? Now, if you're still working on creating excess, you're still working on meeting your financial needs, does that mean you neglect your future? No, you just focus on it a little less. So I'd encourage you guys, if you're still in stages 2 or 3 heavily focused, still look at this to slowly build a pipeline. right? This is a separate bucket of money potentially for you for your future. But I'll tell you, these accounts can actually help you meet your current needs as well. I mentioned to you guys earlier that you can potentially pay for health care and education tax-free as well. Okay, so we'll get to that in a moment. There's 3 ways that your IRA can take a part in a real estate deal. First is sole ownership, so a cash deal. If your IRA has the ability to fund a deal outright, cover any expenses that would come up for it, your IRA can own that property. We're just gonna assume it's property ownership here. Your IRA can own that property 100%, be responsible financially for it 100%, which also means that the IRA will benefit 100% on the back end, okay? Second, your IRA can actually partner. Your IRA can co-invest. Basically what this means is, let's say your IRA is going to buy 30% of an investment property, and you or someone else you know or a bunch of people are going to come up with the other 70%. Your IRA owns that property 30%. It's responsible for 30% of the expenses and receives 30% of the benefit. Am I making sense on that? Okay. So your IRA doesn't have to have enough money to do a cash deal outright. And third, not a lot of people know that your IRA can actually leverage. Your IRA can take on debt. Your IRA can get a loan to buy real estate. It needs to be a non-recourse loan because your IRA can never be used as collateral. And you cannot personally extend credit to your IRA. I'm not going to talk about that one too much tonight, but if you're interested in learning more about this, on your little postcards that were passed out, just write the word non-recourse, and when we give you some education following up, we'll actually make sure we give you information pertinent to that, okay? The reason I show this is I'm gonna show you guys a few deals here that clients have done that are in these 3 different areas. First one, this is quick and dirty, okay? This client has a SEP IRA. This is a client who built her real estate business. She started by putting $5,000 into her retirement account. When she left her job, she rolled over her 401k into her retirement account. She's a high income earner today, and she has a SEP IRA, and if you were to talk to her, she loves her SEP IRA because she can actually put $59,000 into this account from her business each year and reduce her taxable income by $59,000. She's a high income earner. Highest tax bracket is 39.6%. Okay, so that's a pretty significant savings for her to use this account. So this is a deal that she did. It's just a simple rehab deal. She finds a property. Her IRA can buy it for $88,500. How does she do that with her IRA? First, when the offer's put in the name of the IRA. For those of you taking notes, here's the name of your IRA if it's with Equity Trust. The name of your IRA is Equity Trust Company, Custodian, FBO, which stands for the benefit of, and you get your choice of your name or your account number followed by the word IRA. So Equity Trust Company, Custodian, FBO, your name or account number, IRA. So in the purchase contract, it has this name. She signs the purchase contract because she's the owner of the IRA, and then she emails it to Equity Trust, along with a form that we help her fill out called a Real Estate Direction of Investment form. And it's basically a form, if I were to show it to you guys, you fill in the blanks. I want to buy this house at this address. Here's the purchase price, here's the earnest money, here's where I need you guys to send the check, okay? The investment liaison steps in. They work with the client, they work with the title company, because as a custodian, we have to sign all of the closing documents. It's the other nice thing is you don't even have to go to your own closings, right? Because this is your IRA. So in the end, we fund the deal from her IRA as directed by her, $88,500. She then has contractors do $32,000 worth of work. How does she do that? She basically logs into her account and she does online bill pay. And she tells us what contractors to send checks to, when to send them, and we send them out of her account. Okay? Her IRA, after closing costs, ended up putting out about $122,000. Sold the property for $156,500, and the resulting profit of $34,500, which would normally be a capital gain to her, taxed pretty nicely, is completely free of capital gains. Okay? And you go through closing just like you normally would. It's the same procedures, the only difference is the money goes back to the IRA. Does that make sense? So really not that different from what you're doing today. The difference is we have to sign documents and we have to send the check. Pretty simple, straightforward. Okay? Yeah.
So can you do like 88,000 in your self account and you get on money to pay for 32,000?
His question was, could your IRA do the $88,000 and then you come in with the $32,000? The answer is no. In the interest of time, it's just because you're doing what's called commingling funds. But what you can do is whatever percentages those would be, from the beginning, let's say you wanted to go 50-50 with your IRA. You could do that, right, if you wanted to use your own funds, but you'd have to stay 50-50 the whole way. You can't start an investment with the IRA and then come in later with your own funds. Someone else have a question over here? Yeah.
Did you use that to gap fund other projects
That are not yours? Absolutely. Yeah, we have a lot of people that do things like transactional financing with their IRAs. They do short-term loans. They do long-term loans. Pretty much, I'll tell you guys this. There's two things your IRA cannot invest into. One is life insurance contracts. The other is collectibles. If it's not those two things, life insurance contracts and collectibles. Collectibles. Artwork, antiques, rugs, Beanie Babies. If it's not those two things, your IRA can do it. There are some other rules, but we don't have time to go through all of them tonight, but we give you education on that stuff. Annuities, your IRA can have annuities, but it's different than investing in a life insurance contract. Good question. Okay. Let me give you guys another one here. So I told you guys you could co-invest your IRA. We have a client in Indiana. He's able to buy this property for $74,000 and he wants to do it in his IRA, but he wants to also benefit his wife's IRA, so they're going to partner their IRAs together in a deal. John finds out that the state of Indiana is about to do a major roadway construction project, and he happens to find this home that's in the way. Okay, so he thinks this is going to be a pretty good deal down the road. Because of the amount of money they have in their IRAs, John's IRA is going to fund 82% of the deal, and his wife's IRA is going to fund 18% of the deal. Okay? That legal titling is on all the documents. They tell Equity Trust, send 82% of the money from this account, 18% from the other. Any expenses that come up are done in the same fashion. And then the rental income, because they're actually renting this property out, comes back into Equity Trust, and we split it 82%, 18% because they co-invested. Okay? Does that make sense? So what happens is they have a monthly net operating income of $1,650 over the next 30 months that comes into their IRAs and gets split. Then the state of Indiana comes in and offers $210,000 for this property. Okay? All of that money goes to the IRAs, split 82-18, and the resulting capital gain, non-existent, doesn't hit their taxes because this goes to their IRA. Cool thing was this, these guys bought in their Roth IRAs, which means they will never pay tax on this money again. Okay, as long as they have a Roth IRA, have had a Roth IRA for at least 5 years by the time they withdraw. I'll go through two more in the interest of time here, guys. I like telling this story because it's very inspirational, because this client, she's in rooms like this all the time. She's been in real estate for a while. She's a member of her local real estate association, and She didn't know that she could take what she knows and apply it to her retirement account. This family that you see up here, when they first heard about self-directed IRAs, they had about $70,000 or $80,000 saved for retirement and retirement accounts, and they were not happy with the returns they were getting. They learned about this. They came to one of our weekend workshops, and today, I believe they're 9 deals later. This family has in excess of $1 million in Roth IRA wealth, just by doing what they know. Okay, I'm not saying everyone does that, but these people know how to invest in real estate. So they just married the two concepts, and now they have a pretty different financial future ahead of them, don't they? Right? This potentially life-changing stuff. I've met this family. I've seen the emotion on their faces when they talk about how this has changed their outlook on life. Okay? One of the coolest concepts is this, though. This young lady here started a Roth IRA when she was 14 years old. Here's a lesson. You can have a Roth IRA at any age as long as you have earned income. Okay? If you're 75 or you're 12, doesn't matter. As long as you have income, you can start a Roth IRA. She starts her Roth IRA at age 14. Her IRA actually, after a couple deals, took part of this deal in which the family took their IRAs, bought a $300,000 distressed property, had some flood or fire damage, put another $300,000 into it from their IRAs, and sold it for $767,000. So it's a $750,000 real estate deal. The reason I show this is that Brittany's IRA at age, I think 15 at the time, took part of this huge deal, and her IRA only had to invest $19,000. Okay, her IRA bought 3% of that deal. So no matter where you are, if you know people that are investing in real estate, you could potentially do this no matter how much money you have. Okay? And I'll show you one more, and I know I'm going to be a couple minutes over here, but I'll wrap it up, I promise.
You're good.
I talked about wholesaling earlier. Jan wholesales. I'm not going to break this deal down too much, but this was her first deal. Her IRA put $1,000 down to secure a contract for a property. Her IRA had the right to buy this property for $105,000. And she turned around and found an investor where the numbers made sense to buy it at $145,000. And her IRA assigned the contract over and kept the difference. So her IRA made in less than 30 days, made $38,000. Now, this isn't typical. Not every deal works like this, but think about it. If you have $1,000, if she had done this deal and maybe only made like $3,000 on it in less than 30 days, is that still a good rate of return? Yeah. Okay, so it's just a matter of doing what you know to do. So I'll wrap up and leave you guys with this here. I'm skipping, don't worry.
That's all right.
I'm going to leave you guys with one thing. So you see this statement up here, and I truly believe this: to create wealth, we really need to invest with and create tax-free dollars. We don't know what the future holds. We don't know what future tax rates will be. But this is incredibly powerful stuff. Imagine yourself in retirement not having to worry about taxes, potentially living a tax-free lifestyle, okay? It's important to learn all these different accounts because these are potential sources of money to do deals with. We have a client named Stan who, between himself and his family, they have 10 different self-directed accounts, and he's amassed what he calls his constellation of tax-free dollars, so that anytime he comes across a deal, he has these funds that he has to just jump on the deal and do it, okay? So I told you guys I'd tell you the 7 accounts, and I'm going to tell them to you, and then I'm going to leave you and answer your questions afterwards, actually. First 2 accounts are this: traditional and Roth IRAs. This is where 99% of you guys will start if you've not already started. These are your basic retirement accounts. You can roll over or transfer funds from existing retirement accounts, unless it's your current employer's 401k plan, into these accounts. You could also put up to $5,500 in these each year from your own pocket if you're under the age of 50, $6,500 if you're above the age of 50. If you are a small business owner, I already talked about these a little bit. If you're a small business owner, you may consider a SEP or a solo 401k, where these accounts you could potentially put up to $53,000 or $59,000 into your tax-favored retirement accounts each year. Okay? Myself, I have a Roth IRA, I have a 401k that I have through Equity Trust, and I have a SEP IRA for my business that I operate as well. And I have one more account that we've already talked about tonight. You have the health savings account and the Coverdell Education Savings Account. Now, in the interest of time, I'm not going to go into details on these, but if you guys are interested in these, I gave you guys all should have the little cards. And if you don't, I'll make sure you get them after. If you guys go ahead and fill these out, give them to me before you leave tonight. Here's what I'll do. Just last November, we released what I feel is the most comprehensive self-directed IRA education book to date on the market. It's available on Amazon. It was written by Dick Desich. If you guys complete these cards, I know on the back it says you'll get an excerpt from this book. If you guys give me these cards tonight, I will give you guys the entire book, digital copy, and we'll get that to you within 48 hours, okay? Absolutely, I'm happy to do it because I want to make sure I give you guys everything you can to be successful. So with that, I know I'm a few minutes over, so I'm going to wrap up.
No. Let's ask some questions.
Yeah.
Does anybody have any questions?
I know we already took a few questions here.
Yes, sir.
$57,000 a year that you can put into a retirement account that you're talking about, isn't that based on a percentage of income?
Yes, yeah. So when you're talking about the SEP or solo 401k, no, they're different percentages based on your type of income. Afterwards, I can give you a more specific answer for yourself, and then I'll end up deferring to your accountant for the actual answer as well. Yes?
If you have a self-directed defined benefit plan, does it preclude any or all of those?
Defined benefit plans are all falling within the business account range. So if you have a self-directed defined benefit plan that you can do real estate and stuff with, that's great. That's good. Now, if you have an existing defined benefit plan from a past employer and you want to roll that over to an IRA, you can do that. Okay.
You should have a self-directed defined benefit plan. You can still go in and do the health savings and the Coverdell.
Oh, yeah. So his question is, if you have the defined benefit plan, or if you have a 401k with your current employer, can you still do the health savings account, et cetera? Yes. I put these up in 3 different buckets for a reason.
And you can still do the Roth.
Exactly. These are independent from these, and these are independent from these. Okay? I'll go here and then.
So, what kind of situation is the board recommending to convert a traditional IRA to Roth IRA?
So her question is essentially, I'm going to rephrase. She's asking about a recommendation for taking money from a traditional IRA and converting it to a Roth IRA. You can do that. It's called a Roth conversion. You can take money from pre-tax accounts and convert those to Roth IRA dollars. When you do so, the amount of money that you decide to convert is added to your taxable income for that tax year, and then it's going to go into the Roth IRA and grow from there through your investments. I can't recommend to you that you do it or not. Everyone's situation is different. I do find...
Even though you have very lower tax bracket on that specific year, then you recommend?
Well, either way, I can't recommend, but some people in that instance, if you have a very low tax bracket now, may consider doing a Roth conversion. Because they're not going to pay very much taxes as long as they're going to invest it, obviously, once it's in the Roth and grow it.
And you can always convert back when you see tax bracket is high.
You cannot convert back after a year.
You can make that decision when you...
Yeah, you can always do a Roth conversion at any time. You don't have to do all of it at once. Yes? How much is interest in a Roth? I mean, savings account interest these days, it's like, I think we pay a whopping 0.005%. If you're looking to start an account with us for the interest, it's probably not a good idea. Yes.
What is the insurance then again? You say it is?
Sure, the cash in the accounts are FDIC insured up to $250,000. You do have the ability to invest in the market if you're comfortable doing so, but the goal of this is to get started and invest in what you know, which whether it's real estate or private lending or whatnot.
We got a couple more questions. It's 9 o'clock. I want to be, so Mike, right in the back, ma'am? Yep.
Is there a cap on the amount that you can convert from traditional IRA into
There's no cap on the amount of money that you can convert from traditional to Roth. I will tell you guys, just to make sure I'm clear, because I do get some people do get confused. You can do this with traditional IRAs, so you don't have to convert to a Roth to do this. But yeah, you can take that money from a traditional and move it to a traditional IRA and not pay taxes and still grow it, but you do have that option. Correct. There's a self-directed traditional, Roth, all of these ones I just showed you. And then the one more.
Yep, one more.
So how does equity trust earn?
How do we earn our money? So there are fees associated with your account. Here's what makes us different, guys. I know that you guys have seen other providers out there. We do not charge transaction fees. We're one of the only ones that don't. You pay an annual maintenance fee based on the value of your account. And unless you need us to do things like bank wires or cashier's checks, which we all know cost extra, you shouldn't see any extra fees. If you are interested in getting started on an IRA with us, come see me. I'll get you a fee schedule and an application packet. Okay?
Y'all put your hands together for Mike Kozar.